So great company, expensive stock, now what? You found the company you love with strong revenue, margins, great management, but the stock looks expensive. The price to earnings ratio is way too high. The price is going to an all-time high, and everyone is shouting too expensive. So, what should you really do? Let's find out. Besides the gains, they lose value on their bank account because the inflation, we have all done it. We anchor to the current price, we compare it to the past, we think it's too high, we get emotional. But investing is not about the stock price. No, it's about a business. Behind the price is a normal business that generates revenue and profits. And you want to look at the company's main activities. What will the cash flow in the future will be? That's where you want to look at. So you have two things. You have the stock market price that you see every day, but you also have the real value of the company that you might not see every day. But let's find out why the price is not the value of the company. Because great investors like Warren Buffett simplified investing into three questions. How much money will you get? When will you get it? And how sure are you? That's it. A stock is not expensive because the price to earnings ratio is high. No, it's only expensive if the future cash flow doesn't justify today's price. So there are three real scenarios. When you see a great company with a high valuation, one of the three things are true. It's either really overvalued, it's possible. Well, maybe it's that good of a company that it just deserves the premium you pay, or the market is underestimating the future growth of the company. So, what is now your job as an investor? Well, your job is not to gamble and not to guess. Your job is to calculate. So, the first scenario, if a stock is truly overvalued, growth is slowing down, margins are peaking, competition is rising, the stock can run a lot. You have to understand that a stock can run ahead of the fundamentals. And you can see if you are using moving averages over the most important numbers, then you can see the downshift already coming. It's like if you ride up a hill, but your motor is failing. See, you are slowing down while riding up a hill. So you have to know, is that the case? Waiting is good. Waiting is rational. Patience is also a position. So the second scenario, premium is just justified. It's just a good company, and yeah, a lot of other people see that as well. So that's why the price is so high. Because yeah, some companies you probably know them. They always look expensive, but how is that possible? Well, if you think about it, it's really simple. Because they have a high return on investment, and basically they are so predictable and stable. Everyone sees it, and you don't have to do very difficult math to see it. Everyone sees this company is selling, selling, and selling. They compound like crazy, and that's why the price is high. And then your decision is, am I willing to pay the premium? So it could be that an expensive looking stock becomes cheap if you look at it like that. That is where beginners hesitate. And the third scenario is um, markets underestimate growth. this is really an interesting one because the company looks very expensive based on past numbers, but the future growth is underestimated. And there is also a big job for you as an investor. You have to have a kind of vision. Um, how will this company do in the future? Will they get into new industries? Will the industry go up? Do they make new products? Can they find new markets to sell? Can they become more efficient? You can kind of this is also a bit guessing, but you can also researching that, and there's also an edge. And if you find that okay, they will probably become way more efficient, well, then they have a higher profit margin. See, and then future growth may be underestimated by the market. So if you make like a future earnings model, and if you make it correctly, well, there's your edge. And then is it really expensive or is it maybe cheap? So what should you do? Well, what you should not do is ask yourself, is it expensive? No, you ask what growth is already priced in. What growth rate does the stock becomes at what growth rate becomes the stock really fairly valued? You can calculate that in advance and then just wait until the price comes there. So you have to find what margins of safety do I have, and and that is difficult because you need like a structured data for that. And this is exactly why I built Banker's fundamental system. I'm a programmer, basic programmer that just likes came through Warren Buffett and all those guys, and just it was just interesting all those numbers. But because I'm a programmer, yeah, I'm going automatically through the numbers, and I'm trying to display them in an easier way to understand. So if you want to see that as well, it's well, take a look at my site, but you see the numbers structured, and you find a better way to see the cash flow and the future cash flow, the growth of the company, and yeah, you get a way better understanding of the company, and that's where you should begin. And then you come at the most important thing. You have to find a way to calculate the intrinsic value of a company. And that's basically all the cash flows, all the profits from the main activities they have. You combine them and you make a calculation. But I will make a future video about that, how you do that. But that is what you should do. So there are 3 smart strategies you can do, and I have a little bonus strategy as well. If you think, if you found that the fundamentals are strong, but the valuation seems still a bit high, well, you can plan your buys by just scale in slowly. You don't have to put all your money in directly. You can put 10% now, maybe 10% later, 25%. You can also just wait on a price fallback because, well, the president can say something and suddenly the prices are going 10, 20% lower. Well, buy another 10% to 25%, what you want. You waiting is always a good idea. The good part of this, once you are in, you don't get the feeling, oh, I should have bought, because you are in. So if the price goes up, you are pretty happy because your part goes up. And if the price goes down, well, you can buy another piece cheaper, another 10%. So it's both ways. And that's also if you want to sell, well, don't sell your complete position, sell 25%. And if it goes up, well, you still have the 75%. If it goes down, you have some cash to rebuy. That's a good strategy. The things you should not do is stay stuck in fear. Fear is not a strategy. Go to the numbers and go to math. This is why serious investors think differently. So hype investors ask, they are looking at the stock prices all day. I did it myself. And they just ask, oh, I hope it's going up. But serious investors ask, okay, what needs to happen for this price to make sense? Okay, that's a completely different mindset. What you can do is don't look at the go to a new company, don't look at the price at all, and first calculate, and get some price. Try to calculate the intrinsic value, and with multiple yearly time frames. So intrinsic value 10 year, intrinsic value 20 year, and then you basically calculate, okay, the the what price does make sense now? Okay, this stock is, well, I value the stock at like $100, and after you did your calculations, then you look at the market, and you suddenly see that the price on the market doesn't make any sense at all. And that's the fun part of investing, because you already calculated, and then you see suddenly a mind shift into a serious investor. The serious investor knows the company's value, and that's of course not a fact. Everyone calculates it differently, but you have more confidence because you know that number, and you probably know the market is wrong at some day. And then you strike. When the market is wrong, then you buy. When the market, well, the market is always wrong, probably. So the market can be wrong in two ways. It can be overvalued, well, then you can consider selling, or it can be undervalued. Now, then you can consider buying. That's a completely different mindset. And that's how you compound knowledge and money. See, the wise investors like Warren Buffett, when they're not compounding their money and their money is on their bank account or in government bonds, what do? They compound their knowledge for future buying. They already know, okay, if this company goes to that price, I'm the buyer. And that's a big edge you can have. So now you have probably a few stocks in mind that you are looking at that you find, well, expensive. Is it? Let me know in the comments if it's, do you think it's truly overvalued, fairly priced, or underestimated? Comment that ticker below. So next time you see a stock is at an all-time high, don't ask, is it expensive? No, ask, what future is priced in? That single shift separates you from, you lose your emotions about investing, and you start being a serious investor that compounds both knowledge and money. So if you want more investing content like this, well, I'm not a hype guy. I like to use hype in my advantage, but when I'm sitting like now, very calmly, and I will strike when time is right. Well, I will strike when the price is right and the time is right. I focus on structured AI ready data, fundamentals, long-term thinking. If that's your style as well, or you want to get into that, subscribe, because this channel is about compounding knowledge and money.